In this lesson, we're going to explain what a short position is. A short position is simply a position that is open now by selling first, with the intent to buy it back later at a lower price. In the example that we see here, the market has traded its way into supply at $40, where we open our position by selling. As price drops, we close the position when it hits our target at $30. Like a long position, our profit is the difference between where we sold and where we bought. In this case, it's $10 or 10 points for profit. Now, whether we buy first or sell first, it is all going to depend on the market's direction. Now, in order to sell shares you don't own, you can borrow those shares from your broker. So again, looking at this example, the broker loans you one share per se, we'll say one share, worth $40, which you're going to then sell for $40. And you now have $40 in your pocket. Now, as price drops, you buy the share back at $30. You now have the share loaned to you by the broker, and you also have $10 left over. You would then return the share back to your broker, and you keep $10 as a profit. This is the process of a short position and how we can make money in declining markets. Now, when you place money in a bank, the bank does not just hold your money, right? They invest it and they also loan it out to earn interest on that money. Now, in order to borrow shares, you're going to need something called a margin account. Now, on a margin account, let's say you deposit $5,000, you have the ability to trade up to $10,000 worth of stock, because you're going to use an additional $5,000 of the total $10,000 as leverage. And that additional $5,000 is what you're going to be borrowing from your broker. So in this example we see here, right here in this area, in this example we can see there are some situations where shorting a certain stock is just simply not available, okay? It may not be available due to limited liquidity of that particular asset. It may be not available because there's no inventory carried by the particular brokerage house, or shorting the stock may not be available because it's had a recent IPO within the last 30 days, okay? Now, let's go ahead and pull up a chart and let's get a look at what shorting a stock would actually look like on an actual chart. So I'm logging in, kind of fumbling around a bit. So what do we have here? This is Lucid. Let's find NVIDIA. I think I have a short position mapped out already, and I do. Okay, we'll just say 2. We're just gonna say 2, and we're gonna go to the next step. Okay, stretch this out a bit. Okay, so here we have a short position. All right, now just like before, when you're looking at your short position, you're gonna identify your stop, your entry, and your target. Okay, now the first step, you're going to take your target, which is 218.01. You're going to subtract your entry of 22, or actually, we're going to do this the opposite way because we're going short. So you're going to take 22 220.39. You're going to subtract 220.39, subtract 218.01, and that gives you a reward, potential reward of $2.38. So we want to keep that in mind, $2.38. Okay? You're now going to take the amount of your stop loss, which we can see here is 221.02. We're going to subtract our entry of 220.39, and that gives us 63 cents. We're now going to take 2.38 and divide that by 0.63 cents. That gives us a reward to risk ratio of 3.77. So it's just like we did before. We're going to subtract, we're going to take our reward and divide that by our risk. But because we're going short, we're going to take the numbers in a little different order as opposed to going long. Okay? Now, before you move on, review and understand how traders and investors make money shorting and buying to cover stock equity in the market while utilizing a reward to risk ratio. And after you've done so, I'll look forward to seeing you in the next video.